Dollar weighted returns, DWR, is what you actually get to keep. In contrast, time weighted returns, TWR, is what fund managers use to advertise. Jack Bogle, founder of Vanguard, once stated that mutual fund investors typically earn 30% less per year than what's advertised. If a fund advertises a 10% return, you are probably only getting close to 7%. Let's pretend you invested $50 into a fund on January 1st, 2023. After 6 months, your investment doubled and grew to $100. A full 100% increase. You're ecstatic, so you throw another $100 into the fund on July 1st for a total account value of $200. Unfortunately, for the second half of the year, the fund fell flat on its face and lost 50% of its value, cutting your $200 in half. In summary, the $150 that you put in is now worth only $100. But guess what rate of return the fund managers will advertise? For this fund, they will advertise a return of 0% for this year. 0%. What? How? You lost money. How can the return be 0% if you lost money? What they advertise is the time-weighted returns, which is the performance of the portfolio but not what you get. These are completely different things. For an in-depth explanation of how the TWR is calculated, check out the video about it in the description below. As you can see from the example, you lost money, so the advertised rate of return, in this case 0%, is not what you actually get. Instead, dollar weighted returns, DWR, is what you actually get in your pockets. Dollar weighted returns measures the compound growth rate of an investment based on when and how much you put in or take out from it. In other words, it accounts for the real world scenario of making ongoing contributions and withdrawals. The DWR considers both the investor's behavior, for example, timing the market and contributing every paycheck, and how the investment actually performs. DWR shows you how much you really made or lost, not how much the fund itself made or lost. Calculating the DWR is a bit complex, so to simplify it, you would use the Excel formula XIRR. If you're lazy or don't know how to do it, here's a link in the description to a simple dollar weighted return calculator that I made. Here's what you need to fill in. 1. The starting date and starting value of your portfolio. 2. The ending date, for example, today's date, and ending value, current market value, of your investment. 3. Any contributions or withdrawals made to the portfolio. Make sure you put in the date and the amount. Starting value and contributions are positive values. In contrast, ending values and withdrawals are negative values. If you need more rows for cash in or out, you can right-click to insert more rows. Just make sure that you use the correct sign, plus or minus, for each. After you punch in the numbers, the DWR will show up, and that is your actual real-life return. In our hypothetical example, our DWR is minus 46.25%. Your DWR can change depending on several factors, such as how much and when the cash flow happened. In our previous example, we put in more cash right before the market took a dive. However, what if the opposite happened? Instead of putting more cash in, we decided to take cash out. After 6 months, your $50 investment still grows to $100. But on July 1st, you decided to withdraw $50 to pay for a nice meal for your parents, leaving you with only $50 invested. The market takes the same 50% dive in the second part of the year, and you're left with only $25. What's your DWR then? 87.16%. In both instances, you had the same investment, market behavior, and advertised return, TWR. But your one decision to either invest more or withdraw drastically shifted your entire investment return. Paranoid yet? The next time you invest or take money out from your investment, you're going to be thinking extra hard about where the market is going to go, aren't you? Don't sweat too much, because no one knows where the market will go. My main point is that you do not get the advertised rate of return because it is based on an imaginary person who invested all of his money on day one. This simply isn't true for most of us, so we can't delude ourselves into thinking that we get the advertised returns in our account. Our ability and decision to contribute or withdraw shape our actual returns. Unfortunately, this is not the only way your fund managers lie to you and make their funds seem more attractive. Another way they lie to you is through the average rate of return. You can have a 0% average rate of return and be down 43.75% in your account value. How? This next video will break down how financial experts can lie with math.